Hi, and welcome to the Day Trading for Beginners podcast. This is season 3, episode 4. And in this episode, we are talking about why markets wear you down. So we're going to decode support zones for some new traders. So my name is Tyler Stokes from StokesTrades.com. I'm on a journey to become a full-time day trader. And at the moment, I am trading with more of a swing and momentum style and strategy. Now, I outline my trading strategy in our school group. You can find a link to that below in the show notes. It's absolutely free. And if you are a first-time listener, you can download my 6-month blueprint that outlines all the steps that I took on the first 6 months of my journey. And you can get that at StokesTrades.com/blueprint or in the show notes below. And that's going to be a good roadmap for beginner traders just to get started on the right path. So in today's episode, we're talking about why markets wear you down. And I think it goes well with the state of the market right now. So I'm recording this on March 24th, Monday, and it looks like today has been a green day in the market. In the past episode, we talked about liquidity grabs, and I mentioned that March might be looking like one big liquidity grab where prices have been pushed down to low levels. And by the end of the month, we might bounce back and kind of close at higher levels. And in the prior week, we spoke about market structure and how important it is to sometimes, step back and look at the high time frame support, the high time frame market structure, so weekly or monthly, and ask yourself, are things broken down? And, the month isn't over. By the time this gets released, I think I might release it sort of 1 week into April, and would have known if, March finished strong. But what we might be seeing is that market structure is intact. We had a big liquidity grab, and then things are going to bounce back up, and hopefully into the spring and into the summer, the market's going to move higher. So again, right now, today's a green day on March 24th. When you're listening to this in the future, hopefully the market is green and it continued to bounce from today, but who knows? But that's sort of what we're looking at. So today's topic, why markets wear you down, it kind of talks about where we are right now in the market. We keep getting these support zones tested. So we're going to talk about what that is from more of a general trading kind of perspective. Now, if you're a beginner or if you've been trading a lot, no matter whether you trade stocks, Forex, crypto, you've probably noticed, how price can really bounce around like a pinball machine on the charts. And sometimes as beginners, it's tough to know what is going on. But there is some good news. With more experience, you can eventually get a sense of what is going on and maybe come out ahead. So imagine sort of trading where you're not just guessing, but you're actually understanding the game and staying calm while others panic. So in this podcast, really we want to kind of explain how markets test these support levels and talk about 2 quotes, one from Warren Buffett and another trading icon. So this is more of a general kind of discussion on trading as opposed to, a strategy for day traders. So this might not really apply to a specific day trading strategy, but I think this general market knowledge is going to be beneficial for all beginners, no matter what strategy you end up trading with. So we're talking support zones. So what is a support zone? Why does it matter? Well, if you can imagine the price of a stock or anything that you're trading as a ball sort of bouncing around. A support zone, it's like this invisible floor where the price tends to stop falling. So, it's not really an exact number. Sometimes traders call a range. So if we were to say like a range of around, as an example, $45 for a stock, so that would be where buyers often step in thinking, hey, this is a bargain. They buy and the price then bounces back up like the ball sort of hitting a floor. So if we want to imagine 45 as a support zone for a particular stock, just as an example, then buyers tend to jump in when the stock reaches this level. But, there is a catch. The market, it doesn't just, touch that floor once and then call it a day. It keeps dropping back to that support zone. It can do this over and over and sort of testing it. So traders call this sort of testing the downside. So each dip is like the market asking, are the buyers, still here? Will this floor hold or will it break? So in our example, the stock might hit 45, maybe it climbs back up to 48 and then it falls back to 45 again. And it could repeat this for weeks or really even months. Now, although at the time, if you're in this particular stock, as an example, it might be frustrating, if you bought around these levels for whatever reason, and sort of nothing happens for weeks. But it can really be a good sign of building a base. So if support keeps holding for many, many weeks or many months, then a breakout could be next. So many times when things consolidate for a long time, it's like a coiled spring that is eventually potentially going to break out. So this, stability sometimes is needed to mark that bottom, if that bottom is in. So again, hopefully, with support getting tested on many stocks, currently, maybe that bottom is in. So this, studying this and experiencing this, it sort of reminded me of this Warren Buffett quote that we're going to talk about. So, the market, it can sort of, wear you down. So this constant testing isn't just about prices. It's sometimes about you. So that whole mental game of trading is important. When the price sort of keeps hitting that support zone, it can really mess with your head as a trader, or even just as an investor. If you've invested in something, you might not be trading right now, or your strategy might not really worry about this particular aspect of the market. But if you're an investor, and your investments just keep, staying flat, consolidating, then, you can get anxious, you can get worried. So you might think, is it going to maybe crash this time? Is it going to fall? And then many people sell sometimes out of panic in these situations, or maybe, you get tired for waiting for the bounce to actually happen. You give up. So that's the market wearing you down. And it's exactly what Warren Buffett said, one of the greatest investors, when he said, the stock market is a device for transferring money from the impatient to the patient. So what this really means is that the traders who sort of crack under pressure or like sell cheap when the price dips to 45 in that little example we had, they hand their money to someone who is more patient. And sometimes those patient traders, they can wait. They can wait it out if they have the time. They can buy lower. They can trust that the support will hold. And then if price eventually climbs out of the 45 and up and to the right, they're going to profit while the impatient person and trader loses out. So, if you picture the stock dips to 45 repeatedly, the impatient person sells, fearing that a drop to 40 might be coming. The impatient or the patient one is going to hold, buy, maybe even buy lower. And then when it rebounds, they're the winners in the long term. They can accumulate wealth using sort of this buying support levels in a good market structure. So the market is going to reward those that stay calm during that grind. Now, the market also has a crazy side that, beginners need to be aware of. And sometimes you don't know this until you've been in the market studying it for, maybe even over a year. So sometimes, it's hard to become a good trader if you don't have that experience in being able to see what the market is potentially capable of doing. So it does get a little tricky. Sometimes the market, it doesn't bounce back when you expect it to. It might hit that support zone. It might break through, stay low, or just sit there for way longer than seems rational to you. So maybe it's bad news, or maybe rumors around whatever security we're talking about here, or just, chaos driving prices in that particular direction. And this is where the famous trading saying comes in. It's often linked to the economist John Maynard Keynes. The market can remain irrational longer than you can remain solvent. So what this means is that you might be patient waiting for that $45 support to hold. But if the market, acts nuts and the price drops to 35 and stays there for maybe months, you could run out of patience, or maybe run out of money if you're on margin. And insolvent in that quote, basically it just means having enough cash to keep going. So, if you bet too much, maybe you borrowed money, or maybe you were in a scenario where you wanted to short a stock and for whatever reason, it just kept going up, the market can remain irrational to you longer than you might be able to stay solvent with your margin, your balance, or your shorts that you might be shorting. So that is something that you need to be aware of, and it should be something thought about to help you sort of manage risk wherever you are trading. Now, another term that comes up that I've come across a lot, and I wanted to sort of get clarification on, is capitulation. So what's capitulation? You may have heard that before. And basically, here's a beginner's sort of take on it. So again, you may have heard that term, in the market, capitulation. People on YouTube or other podcasts may have thrown it around in trading chats or videos. It sounds dramatic, but it is rather simple. Capitulation, that happens when a large group of traders collectively throw in the towel and then abandon their position. So if you can picture again, that support zone at 45 gets tested over and over. The price dips, buyers fight it to hold it. Then it breaks to 40. Panic sets in. Everyone starts selling like crazy, thinking, I'm done. It's going to go, even further down. That flood of selling is capitulation. It's the moment that the last holdouts throw in the towel and it drives the price down even lower. And why this matters is that capitulation usually marks a bottom in the market. It's the point where selling exhausts itself and the price might finally hit a floor and eventually rebound. So, in that example, maybe the stock even drops to 30 and everyone's sold from 40 all the way down to 30. Smart buyers, the patient ones that, we talked about with that Buffett quote, might swoop in. The price climbs back up. And that's sort of goes in hand with what we talked about in the last episode about liquidity grabs. Maybe these market makers have been pushing the price of this particular stock, for example, with news narratives and various other tactics, selling pressure at 40 to get everyone to capitulate and sell. And now it's driven the price down to 30 and they'll swoop in and buy at 30 and wait for the rebound. So the trick is to recognize it after it happens and not jumping ship with the crowd. So basically, beginners, they miss this. The capitulation looks scary, but it can signal a turning point, and it is important to recognize it after it happens. Don't sell with the panic herd of the market. Don't capitulate. Just sort of try to understand what is going on in some of the investments that you might be holding. And here's a real example. It's easier said than done, and I can speak from experience as well. Back in January 2023, Tesla stock, if you've been following that, it plummeted to a low of $101.81. So it was down over 65% from its peak the prior year in 2022. After, I think there was weaker Q4 delivery numbers than what Wall Street expected, sparked fears of slowing demand. And then we had the whole China competition with discounts, that discussion. We had Elon Musk buying Twitter around that time. So I think he needed to sell a lot of shares. So the drop really triggered capitulation, mass panic selling as traders gave up hope with over 220 million shares were traded on January 3rd alone. So that was a big trading day. Many people were selling. And I think, I don't know the exact time I sold, but, I have an investment in Tesla. And I forecasted I needed some funds throughout the year of 2023. And I was thinking, what if this goes down to 60? I don't want to have to sell at 60 if I need some funds. It's at around 100 now. And I actually sold a little bit of my shares because I needed the funds. And looking back, I capitulated there. I'm looking at 100 and it's going down. And do I want to sell next month if it goes down to 60? And I did sell. So sometimes, looking back, is there something I probably could have done differently? Probably. But when you're in that moment, it can be difficult for an investor or for a trader, especially if you don't have any knowledge of technical analysis, which I didn't. If you don't have experience in the markets as well, many people sell like I did, and many people got out. If they bought, when Tesla was up at 400, 300, they got out at extreme losses. So, but looking back now, that capitulation, it really marked a turning point. By the end of that month, I believe that end of January, Tesla, that stock rebounded to 173. So many people sold out in the low 100s, sold at a 101. And by the end of the month, it's up like 45%. And I think it hit 207 in early the next month. Basically, that warning, the market can remain irrational longer than you can remain solvent. I experienced that because the market was irrational for Tesla to drop so low. I needed the funds. So I was forced to sell for, whatever reason I needed those funds at a extremely terrible price. And then the next few months, the stock doubled. So it's a real quote, and I experienced it. And, if you are unaware of it, then you may experience it as well. So hopefully now listening to this, you can be a bit more aware of that. And, for beginners, it's this example is a lesson in surviving emotional sort of market swing. So as a new trader that you might be, or you might be getting into trading and investing, what can you take away from this? Well, you can learn to spot those support zones, learn market structure, which we talked about the last few episodes, be able to look at a price chart and find maybe confluence with various indicators that a support level is in. Ask yourself, have things broken down on the high time frame chart. So I believe that if I had more the knowledge I have now with technical analysis, I hopefully would not have sold at such a low price the few shares that I did there. You can, hopefully learn to stay patient. Like Buffett says, when the market tests that zone over and over, don't panic sell just because it feels shaky. The impatient lose, the patient win. So depending on your strategy, hopefully you can be patient with something. If you're day trading, then obviously you're in and out of trades on a single day. But if you're day trading, you might also be swing trading, and you might also be investing. Ask yourself, is this a real break, or is it just the market testing me? Another thing to consider, don't overbet. The market can go haywire longer than you think. So, if you have an account and you go on margin close to your max margin account, and, something happens in the geopolitical landscape, there's a war, there's a threat, the market can be more rational than you can potentially be solvent, especially if you're borrowing on margin. So, very important to know your risks in that regard. Watch for capitulation. If a support zone breaks and selling goes wild, you might, depending on your situation, maybe, don't join in. Maybe that is going to be the mark of a bottom. And again, recording this, hopefully the end of March is a mark of the bottom of the markets. And you'll know this when you're listening to this the following week. So the bottom line here, trading isn't just about the numbers. It is a big mental game. It's a huge, huge mental game. Whether it's for sticking with your strategy, or whether it's, in what we talked about today, where might not be related totally to strategy, but can be related to some more of your long-term holdings as well. These markets, they test the support zones to shake out the impatient. The market makers are shaking all the retail traders out, getting them scared, getting them to capitulate, selling shares at the low prices. And these people, these market makers, these experienced traders are swooping in and potentially buying at really low levels, which might be happening here at the end of March. And as Buffett points out, they can also stay irrational longer than we can hang on. And that's a classic warning that we need to get reminded of. Capitulation, it's the wild climax of all that chaos, but it can signal an opportunity for those sharp investors and traders. So as a new trader, our job is to really learn the patterns, keep your cool, protect your money, start small, watch for the floors, and don't let the market sort of wear you down. Sometimes easier said than done, especially when you were starting. But this is also why, it's recommended to paper trade, find a strategy, and trade it for many, many months, because the market changes. You're going to be in a bull market and you might be making money, but you might have months like February and March of 2025 where, your strategy certainly won't work, and you might have to step back, either change your strategy or be very patient and maybe not make trades and wait for things to recover. So experience in the markets, I think, is really important. And it's one of the reasons why it can take longer than we hope to become really good at trading. So I hope that you found this useful. In the show notes, again, you can find a link to our community on School, where you can learn more about the strategy that I am currently following. You can find some resources there as well. You can download the 6-month blueprint if you are a beginner. That's a good roadmap to get started on your journey to becoming a day trader, a trader in general. So thanks so much for listening, and I look forward to speaking with you in the next episode.